Hello, very good afternoon, good morning. Welcome to the FX Week Ahead live market analysis with myself, Giles Cochran, Chief Currency Analyst. I do hope everybody's doing well. Good to see you, Alejandro, Ignatius, Johan. Welcome, Massi. I think this is your first time here. Maurice, good to have you. Mohammed, you're good to see you back. Just as other folks are coming in, a very warm welcome to you. What an interesting week, and really looking forward to outlining what the major market moves are, what we need to look out for, and the potential opportunities that we see. So it's an important week, and it's a sort of week where it's easy to sort of give away gains, get into silly trades. So I do hope this is going to be a helpful time. Just as other folks are coming into the webinar, don't forget that any trade ideas, any instruments, take profits, stop losses. The whole idea of this webinar is an educational perspective. It's not a signal trading service. And the things we're looking at today is the US core PCE print. That is going to be the most interesting release of the week because it's all about inflation at the moment with markets and whether we've hit peak inflation. The core PCE print is the Fed's preferred measure of inflation. So that will be the most important instrument to trade this week. And the workshop on Wednesday will specifically look at trading it. Well, how to trade it, which are the best instruments, what print will result in which direction. So don't forget that. We're looking at inflation and oil, link between oil prices and inflation expectations. CAD, China 50, the dollar, we'll be looking at the peak dollar story and of explaining that. Also Japanese yen, what to watch for in terms of surprise Bank of Japan intervention. The Bank of Japan latest summary of opinion out, and the Bank of Japan are concerned about the weakness in the yen. So sudden yen strength is a definite possibility. You have to be aware of that. Be very careful of shorting the yen right now. And also the German inflation data to set tone for eurozone inflation coming up, and stocks when and where they might bottom. So there's a lot for us to look at. Don't forget, as we're going through different entries, exits, we're going through lots of different issues. Please, Massey, oh yeah, Massey is Max. It's only, yeah, okay, Max. That's good. Well, good to have a friendly face here as well. So yeah, great. Lots and lots to cover today. So if there's something you don't understand or want clarity on, just bang a question in, okay? And I will try to get to it. If I don't get to it during the session, I will definitely get to it at the end, okay? So just bear that in mind. And I want to start by giving us a really good overview, because an overview is so important, and it really is. So before we get into the calendar, markets have started risk on today, and those risk on markets are really flowing from equity markets from last Friday when we saw equity markets push high. Now, there wasn't any catalyst for this. There wasn't anything that was obvious why this equity markets might move higher. If you notice, we've been seeing equity markets falling recently on the expectations of more aggressive Fed policy action. We've now got to the point where we're quite close to peak monetary policy expectations. Now, the most likely reason for the recent upside in equity markets has probably been in bond market. Now, if you just take a look at the bond market, what you can see is, you see how the bond yields were pushing back last week. Bond yields are moving down, moving down, moving down. And all of this is the bond market expecting less aggressive monetary policy from central banks. Now, let me show you this via the Fed Fund futures and the SONIA strip. Now, if you just take a look at the Fed Fund futures and the SONIA strip, I hope I'll show you it here. So there's a bit to cover this week, but I want to make sure we get on top of it. Here you go. Now, you see the Fed Fund futures, SONIA futures, to see the way they pulled down. So what this tells us is, like, this is the December Fed contract, and you see how prices have now moved down to 3.6. They were on the 15th of June, 14th of June, they were expecting the Fed to have interest rates at 4% for December 2023. That's now dropped down to 3.6%. So similarly with the SONIA futures, you can see that aggressive monetary policy action from the UK has also retreated. Why is that? It's because markets are beginning to sense that actually growth is likely to be hit. So if growth is going to be hit, and if inflation can pull back, and we have seen peak inflation, then central banks won't need to be so aggressive. That's the most likely reason why equity markets are pushing higher. Now, there's no to trade in these major equity markets, obviously, at all. The only equity index that I'm actively been trading is the China 50 index. Now, I've pointed this out a number of times because that lovely hammer reversal bar. This wasn't why I took the trade, but lovely hammer reversal bar found some support despite all those lockdowns in Shanghai, Beijing. Now they're being relieved. We're seeing China looking like coming out of lockdowns. It's obviously an open question whether they manage it and to what extent they manage it. But People's Bank of China looking at cutting interest rates. We've got, let me just show you. Hang on. Right, I'll show you this. Just bear with me 1 minute. Sorry about this. My computer crashed just before I started, so I haven't got all the slides up I need. That should have been there. Right, just going to quit the preview. Try it again. Right, there we go. Now, if you just take a look at this graphic, and just get another couple of graphics I want up as well. If you just take a look at this graphic, what you'll notice is that 1/3 of China's economy, $5.3 trillion worth, is being boosted in terms of general monetary and fiscal support into China's economy. So unlike the other central banks, which are looking at hiking interest rates, People's Bank of China is looking at cutting interest rates. And unlike other central banks in the West that are looking at reducing support for their economies, China is looking at increasing support. Now, that's in part due to that retreat in China's 50 index took place starting from February 2021. You see, and it dropped nearly 40%. And now we're seeing a little bit of a recovery. Now, crucially, we've moved above that old support level, that old floor at 14,500. Old ceiling becomes the new floor. So intraday, any retracements back down to that 14,500 region remains suitable for buying, absolutely fine, and potentially looking for a move back up towards that 15,500 region. And then if that breaks, back up to 16 and 16,500. So China's 50 index remains bullish. It's the only major index which I remain bullish on. I have been long for some time in China's 50, but there is an opportunity to potentially join with stops just underneath that sort of 14,200 region. That does look suitable for buying this week. But that's the most likely reason. Where might stocks bottom is very hard to say. Obviously, the S&P 500 has now fallen a 25%. This is the kind of region any further falls, and typically the US will enter into a recession. So it's going to be crucial for the US to avoid a recession if we're going to see equity markets keep moving higher. So if we start to see peak inflation, and Thursday's data will be crucial, then we may well see some more upside for the S&P 500, but there's nothing that's obviously tradable here, okay? I think if you were looking at rejoining this market for longs, I would be inclined to wait for some technical break that gives you some kind of reassurance that there's been a technical shift. And you can see here in previous downtrends, when we have a technical break to the upside, that tends to be a pretty good signal. At the moment, major equities are still in bear market territory. And this is still most likely to be a bear market rally, despite what we've been talking about. Yeah, Cian says sometimes when central banks actually act, the market wakes up briefly. Yeah, although expectations that they're going to be doing less. I think a lot of it's going to come down to inflation expectations, CN, and that does potentially provide some opportunity. So we'll look at that later on. Hong Kong has been stronger than China's equity market. Yeah, and they've had some very nice recovery. Okay, oil markets picking up just in line with that better sentiment. Copper prices trying to find some bottoming action there in line with a more positive risk sentiment. Gold and silver still moving pretty sideways. Silver prices, watch out for silver, particularly if we get a US core PCE miss on Thursday. I'll tell you why. The gold-silver ratio is pushing up. Now, the gold-silver ratio is a really good indicator for seeing what the price of silver is relative to gold. Now, let me just show you this. That's silver prices. Now, if I just put here gold-silver ratio and overlay this, what you'll see, very helpfully, is I'm just going to change the color for this, but I'll show you. Let's just make the gold-silver ratio, let's make it white. Right? So you can see when the gold-silver ratio is high, what it does, it tells you is that silver is cheap relative to gold. So this was a great trade I took in 2020 when everyone was talking about the gold-silver ratio being so high and everyone was really bullish silver. Now, I entered long silver, and annoyingly, it was an amazing trade. And I didn't get very much of the move, even though I saw it coming, which is annoying. But you can see the gold-silver ratio, fantastically high, right? And then you see silver was able to really pick up. So when the gold-silver ratio is high, often it results in some nice upside for silver. So high gold-silver ratio, and you tend to see silver pick up, okay? Low gold-silver ratio, you tend to see silver drop, right? So you can see here, high gold-silver ratio, silver picks up. High gold-silver ratio, silver picks up. At the moment, the gold-silver ratio is starting to pick up, you see. So what we'd expect to see is silver pick up. Now, it doesn't always happen at the same time. You see here, gold-silver ratio extremely high, but silver hasn't picked up. So here, gold-silver ratio is high, but you see silver hasn't picked up yet. So in other words, any reasons to buy silver or gold, I'm expecting silver to outperform gold. Okay, so keep your eyes out on that. It's definitely something to be looking out for. I will explain why in more detail in due course. Euro pound, I've got a medium-term sell bias now after that very weak PMI data from Europe last week. Now take a look at this. We had those big surprises, big misses to the downside on the eurozone. Now, was it the data on the Friday? It may have been the Thursday actually. Let's have a look. Okay, let's see if that. Just want to try and call up the actual data. I'll just do it from day before, see if that's slowing things down for some reason. Right, let's have a look. Here we go. Do you see that big, massive miss in the euro? The PMI data across the whole zone was below minimum market expectations. So when you start seeing, markets coming in below minimum market expectations like that, that does send some warning signs that the eurozone is really slowing in terms of growth. Economists not projecting that at all. So real big surprise in terms of the euro. That does put the pressure. We've got a couple of ECB speakers out today, and that does put the pressure on the ECB to not be so aggressive in hiking interest rates. Now, I do quite like selling from that 0.8670 region. Stops can be placed just above that 8.720 region, just above 8.727. So any moves back up to this region look suitable for shorting because of that very weak euro bias. Now, it's not that the pound is bullish and we're expecting massive euro pound falls, but the bearishness for the pound has been priced in for quite some time. So, and you can see here how the euro has been gaining against the pound for quite some time, you know, since April. But now, with that slightly worse outlook for the ECB, it wouldn't be surprised to see the euro pound drop lower in the near term. So look out for any reversal signals. I would be quite happy to sell at a limit order at 0.8670. So look out for that in the euro pound. That's definitely something to be keeping our eyes on. Okay, folks, that's the major stories that we're on top of. Dollar is quite close to potentially peak hawkishness. We have seen a lot of dollar strength as of late, and I'll just explain to you why. The dollar does tend to gain, right, when you see global growth slowing down. And we've seen, like, US data surprise to the downside. We've seen global data surprise to the downside. And so we've seen a lot of the dollar strength already in place. We've also seen a lot of dollar strength from the fact that the Fed's expected to be more aggressive. Now, with Fed fund futures pulling back, and a lot of that hawkishness being priced into the dollar, and the dollar is quite bullish in terms of cop positioning, it wouldn't be surprised to see a dollar correction coming up. So look out for a dollar correction, and in particular, look out for a dollar yen correction. That will be very, very attractive because of the Bank of Japan. If they intervene in the yen and they start wanting the yen to weaken, they start wanting the yen to strengthen, and they're concerned about yen weakness, then watch out. This could potentially be a top now for dollar yen. So look for opportunities to potentially short, and watch out if you're long the dollar yen, because the Bank of Japan could intervene at any time. Okay, folks, that's key for the dollar. We covered the bond market. Oil markets. Oil markets track inflation expectations very closely. So if oil markets keep falling, then inflation expectations fall. If oil markets keep rising, then inflation expectations will rise. The reason for that is because oil goes into everything. You know, if you want to produce something, you need energy. If you want to move something, you need energy. If you want to build something, you guessed it, you need energy. So the higher energy prices are, impacts costs across the board, and high oil equals high inflation expectations. So if oil prices keep dropping lower, then that impacts inflation expectations. The lower inflation expectations are, the less aggressive central banks need to be, and that supports the risk on sentiment. So just keep your eye on oil markets. There's a lot of idiosyncratic drivers for oil markets, so it is a complex picture. Now let's look at this week. Very light on the calendar this week. We haven't got any massive drivers of sentiment, so just look for the risk tone to ebb and flow. Watch for any breaking news to change things. There's news about the Russian debt default, unlikely to move markets at the moment because the Russian debt default is a very technical default. Russia has the means and the will to pay the default. It's a technical reason that it's actually defaulting, and most bond traders and bondholders are going to adopt a wait and see approach. So if that Russian-Ukraine risk fades, then it shouldn't have any impact on the euro or on the European stocks today. ECB, Lagarde and Schnabel, the more they move towards growth worries, the more euro weakness we can see, the more optimistic they are about the ECB needing to address inflation by hiking rates aggressively. The more they move down that narrative, then the more euro strength we'll see. So that's what we need to look out for. Particularly look for ECB speakers responding to that PMI data slowing down. Okay, Bank of England Cunliffe speaking, that does have some risks for the euro pound outlook, and obviously we want to keep seeing that divergence in place with the Bank of England, you know, pulling back from that peak bearish position. Anything optimistic from the UK will be good, and anything very negative for the ECB in terms of growth will keep that euro pound bias going. At the moment, that euro pound sell bias is still in place. Fed daily speaking, so a lot of Fed speakers coming up. Wednesday, 28th of June, we got eurozone ECB Guindos speech. We got ECB Schnabel's speech. We've got Fed Mester's speech. So a number of different ECB speakers will be really coming across the wires. Now, they're unlikely to say anything that we don't already know. So it's unlikely to be moving the euro, but just to be aware of that. The basic outlook is that eurozone growth is starting to weigh on the eurozone interest rate expectations. So look out for that. We've also got Bank of England Governor Bailey's speech and Fed Chair Powell's speech on Wednesday. What we need to look for Powell is any indication that he's concerned about slowing growth. If he starts indicating concerns about slowing growth, then we'd expect the US dollar to start falling. If he keeps up with that, you know, we're going to be hiking, then the market's already tuned into that. So that's not going to particularly move markets higher. What markets are looking for is any indication that Fed Chair Powell is getting concerned about the US entering into a recession. If markets pick up his comments and interpret them that way, or is explicit in his concerns about the worries about the US growth, they expect dollar weakness. And so the pair you'd be looking for something like euro US dollar upside, pound US dollar upside, Aussie US dollar upside, particularly if the risk tone remains positive. Aussie and New Zealand US dollar upside will be good. Thursday, we got PMI data out of China. Now, this is the services PMI for the non-manufacturing and manufacturing price. So we'd expect to see this start picking up. Okay, so expected for the services PMI 51.9 up to 47.8. Now, a lot of Chinese lockdowns started to lift, didn't they, around the end of the May, turn of June. So that should be good. And if that sort of surprises to the upside, that should give China 50 a nice little boost to the upside. If the manufacturing PMI is expected to drop down 48.6, but if that can show some strength and above 50, then you'd expect that could potentially give some more upside to equity markets if they're still in their current climate of, you know, moving higher without any particular catalyst. So that's significant. And often China's outlook will set the risk tone or expectations for the day. Looking at the core PCE data, this is the key data for the week. Now, you can see the PCE data is expected to move up 5.1% for year on year and 0.4% for the month on month, up from previous 4.9, up from prior 0.3. So this is the big question. Markets are expecting interest rates to inflation to move higher. This is the Fed's preferred method of inflation. So this is very important for the Fed, and this is what we need to see. If it's high, say it comes in above 5.6 and it comes 0.6% and it comes, you know, above 6.7% for the headline, then we may see a little bit of extra dollar upside, but it's unlikely to keep going. The best tradable outcome from here is if we see this PCE data come in below 5.1% and below 0.3%. So ideally, if it came in at 4.9 or 4.8 would be the best because it's below the prior. And if this is below 0.3, so 0.2, that would be really good. And I would like silver upside in that environment. Gold upside, euro US dollar upside, pound US dollar upside. Now we can come back on Wednesday, and we'll look at that in detail. But now, from where I'm standing at this point in time, silver longs would be looking attractive on a miss. Okay, because the gold silver ratio is quite high. Silver looks better value than gold, so a nice potential opportunity would be silver. Should we get a miss on that data point. President Lagarde speaking again later in the session. It'd be interesting to see if President Lagarde picks up on this. So if we see peak inflation from the US, you might find that impacts President Lagarde's speech as well. If there's a big relief, then you might see that flowing through into President Lagarde, and she may be less concerned about hiking interest rates. So you could also see some euro downside from that as a byproduct. So watch out for that response. The Friday, got CPI flash data, and we've got the eurozone inflation rate coming out. Now that's going to be very interesting. Inflation, the higher this is, that keeps the pressure on the ECB to hike interest rates. The best opportunity would be if it comes in low. So if it comes in below 3.5% euro pound downside, below 7.9% euro pound downside. Okay, that's the best opportunity to be looking out for in the eurozone inflation data. And then we've got the US ISM manufacturing PMI. Now, obviously, we've got to bear in mind what's happened with the PCE data, but the dollar is trading more cyclically now. So the last, few data points, few weeks, we've been seeing cyclical movements of the dollar. Good data, good for US dollar. Bad data, bad for US dollar. So if this comes in sub 51, 52, so if we get a 51 data point, but downside dollar, upside euro US dollar, upside pound US dollar. That's what I'm roughly looking at today. I think that's good opportunities for us to be looking for. It's going to check the Q&A. Yeah, CN's, watch interest rates as a driver for equities. I think that's exactly right, CN, and I think that's the major driver for equities at the moment. And for those of you who don't understand CN's point there, if interest rates go very high, it means that conditions for businesses are less conducive for business, because their current debt repayments increase. Their future investment is harder because they're going to have to incur more debt in order to invest in the future. So it just shrinks everything. So if interest rates keep going up, it means business conditions are worse. And if business conditions are worse, it means future profitability is likely to be hit. So it means indices move lower. So the main concern at the moment is that if central banks have to hike so quickly, and they have to do it to bring down inflation, but at the same time they end up hitting growth, then equity markets could really be hit. That's the sort of fear that the market's trying to play with, So a key driver for equity markets remains interest rates. But as you can see, at the moment, what we've seen is another bear market rally. And we've had lots of bear market rallies. And sometimes in a bear market rally, you can get really decent rallies. So here, in the Dow, look, we've got a move here, a 7% move in the bear market rally. All right, that was a bear market rally going back to start of the year. Then here, 10%, another bear market rally. So you can get these sort of decent 9%. These are decent moves, okay? So the key bit to remember is what's going on. And at the moment, do we want to go long here? No. Do we want to go short here? No. Okay, we're not in an optimum place for either. We're right back in the middle of that range. I hope that sort of helps. Nat gas doing a job on the euro as well. So CN, natural gas. If that can keep moving lower, that will alleviate energy prices. And the lower that natural gas, the lower that oil prices can move, you might start to see some relief about inflation expectations coming into the market, and that in itself could be a nice boost for equities on interest rate relief and inflation expectations relief as well. One interesting point is positioning. Just wanted to point out to you that, and you can see this is important for us because the retail crowd are often very wrong. Just look at this. That we had the Swiss National Bank 2 weeks ago hiking interest rates by 50 basis points, dropping the highly valued Swiss franc label. In other words, there were some very, very good reasons to buy the Swiss franc. And look, retail positions from last week and this week, they are predominantly short the Swiss franc. So at the very time you want to be buying the Swiss franc, look, the retail crowd are selling the Swiss franc. So, that's just helpful to see that the retail are very badly positioned, buying pound Swiss franc, buying the Aussie, buying the euro Swiss franc. In other words, they are selling the Swiss franc when they should be really buying it. That, and again here, they're buying the Swiss franc, Japanese yen, and the majority are selling. So they're like just completely wrong, basically. And potential areas where it does look good for the Swiss franc is any retracements back up to the 50% level here look good for shorting. We don't want to short from current prices because like we've had the move, okay? We've got this lovely bearish reversal hammer bar on the monthly, right? There is some major support there. So there is a target of 0.9450, 0.9500, fair enough. But what we want to see is we want to see price retrace. So look for price to move back up into this 50 fib retracement area. So around here, right? That looks suitable for shorting. Right? Anything just underneath 0.9800. Look for that to potentially short. Okay, I've got a sell limit order up there. Swiss franc, Japanese yen looks good for buying because that's interesting. We are seeing a Harami inside bar there on the daily. So just look here. The Swiss franc is gaining against the yen. The only risk with this trade is if the yen suddenly strengthens, if there's some kind of FX intervention. But if you look at here, there's a Harami inside bar that is potentially setting up for a breakout. So look out for that. Any retracements to 138 is fine, but don't have a limit order here because if the Bank of Japan suddenly intervenes, then this could fall 300, 400 points in a shot. So you don't want a long stop. And if you do go long Swiss franc, Japanese yen, remember the yen could suddenly strengthen because a weak yen is not good for Japan's export market, importers, okay? And so there's constant, chatter. What will happen? Will the Bank of Japan act against the weakness in the yen? Is your nat gas chart US or Euro nat gas? I think it's US. CN, counter retail position doesn't always work, just a suggestion for position. Yes, a very good point. It doesn't always work, of course it doesn't, but it is an interesting learning point, CN, because really, yes, okay, we're expecting a little bounce in these pairs, but if you look back from last week, this isn't retail cleverly positioning for a bounce. This is retail remaining on the wrong side of the Swiss franc. So I'm not, of course, I'm not criticizing retail, but more what we can learn from and just seeing that actually with retail so still heavily skewed one way, the other way of looking at it is we might see some more buying in the Swiss franc with so much pain out there for retail. But yeah, fair point, CN. Okay, folks, we rattled through things. Been great. We'll be back here on Wednesday and we'll look at that US core PCE data in more detail. Thank you very much for your comments and questions. Really enjoyed it. Thanks for your input, CN. Absolutely great. And look forward to being here on Thursday. Take care, everyone. Goodbye.